Hello, my name's Jeremy Gray from your International Business Channel. Today, thick versus thin capitalization, what you need to know. Yep, we're getting down into the technical weeds now. Remember, my aim is to ensure that the profits you make can be sent back to your home country, can be repatriated if you choose. Expanding your business internationally, of course, means navigating a maze of financial and tax regulations. Amongst some of the most complex rules are those rules regarding repatriation of profits. Every country has its own rules when it comes to taxing foreign businesses. This includes how profits are taxed, what incentives may be available for foreign investments, and what you can legally repatriate back to your home country. These rules can be incredibly complex, and no two countries handle them the same way. For example, some nations may offer tax breaks or incentives for companies to invest in certain industries or regions. I believe recently India was offering $1 billion to anyone who wanted to build a chip manufacturing plant in that country. Others can have strict rules about how much profit you can transfer back. Failing to comply with these regulations, of course, can lead to significant penalties or even legal trouble. So let's talk about the role of funding structure in international taxation. How you choose to fund your overseas operation isn't just a financial decision, it's also a tax decision. Your funding structure can have a significant impact on your tax liabilities. In general, companies use a mix of two funding sources, equity and debt. Equity, of course, this involves investment from shareholders or uses retained earnings. Investors are obviously rewarded by dividends or an increase in the share price. Debt, this is money lent to the company by third parties. And because you're a separate legal entity, one of those third parties can be your parent company. Lenders, of course, are repaid through interest payments plus capital download. The balance between equity and debt is not just about finding the optimal funding, it's also a factor that the tax authorities around the world are going to keep a close eye on. Thin versus thick capitalization. What's the difference? The ratio of debt to equity at a company is often referred to as its capitalization structure. Depending on this ratio, a company may be described as having either thin or thick capitalization. Thin capitalization. When a company's ratio of debt to equity is high, it's considered to have a thin capitalization. Essentially, the company is predominantly funded by debt. Thick capitalization. The opposite to thin capitalization. Thick capitalization means the company is primarily funded by shareholder investment. Why do tax authorities care about this? It's because thin capitalization sometimes can be used as a strategy to reduce tax liability. Here's how it works. Interest payments on debt are often tax deductible, which can lower the company's taxable income. While this is a legitimate business practice, some governments have rules to prevent companies from using excessive debt to avoid paying taxes. These are known as the thin capitalization rules. Here's the issue as far as tax authorities are concerned. I mentioned that one of the lenders to your overseas company can be your home country, your parent company. Now here's how it works. The parent company loans a lot of money to the subsidiary at an interest rate favourable to the parent company. The subsidiary pays debt interest back to the company, leaving no money to be taxed in the home country because it's all been paid back to the parent via dividends. Sorry, I meant interest, not dividends. You can see why tax authorities might get upset by this type of practice, hence thin capitalization rules. Understanding and managing your capitalization structure is key to avoiding trouble with the tax authorities and ensuring that your business operates efficiently. If your company has thin capitalization, you may face restrictions on how much interest expenses can be deducted for tax purposes. On the other hand, having thick capitalization may mean higher upfront costs, as shareholders will expect a return on their investment. Balancing equity to debt is not just about complying with the law, it's also about maintaining your financial stability. Too much debt can leave your business vulnerable during economic downturns, with too much reliance on equity might dilute ownership and reduce returns for existing shareholders. If you've enjoyed this short video, please like and subscribe. I would very much appreciate that. Want to know a little bit more about taking a company overseas? Go to my3cc.com/overseas, and there you'll be able to download a helpful PDF, which I hope you would find useful. Finally, I wish you fair winds and following seas on your international journey. Take care.